So now we get to turn to Asia and what's happening there. We had a lot of data that came out from China, and we want to talk about the data in pieces, but first we want to look at the outbreak that is spreading. So Shanghai is saying that things are on the downward trajectory, but it's starting to spread out. So as anybody who has gone through Omicron, as somebody who's had it in their household, if you look at someone, you get it. So again, we expect this to continue to spread. And the problem is, if you look at just where it is being hit, these are huge GDP juggernaut provinces for China. So it's also a juggernaut for exports and for the U.S. We were just talking offline, prior to starting the filming this segment, of just how much trade goes through China and just Asia in general. When you look at the U.S. and our trade with China, which is number one. I think I actually still have up the chart. So China, when you look at the end of last year on a yearly basis, China was 687.2 billion. Mexico, Canada, Mexico 618. But then you look at Japan, 217, South Korea, 168.6 billion, Vietnam, 117.4 billion, India, 114.6 billion. So again, this is a huge piece, because also how much of the Chinese goods go to Japan and then from Japan to the U.S. And Japan is kind of in between China and the U.S. Same can be said about South Korea, about Germany. So again, this has such a reverberating impact that's going to continue. Now, the other thing that I think is important is China depends on the U.S. and her allies for semiconductor equipment. So as China wants to increase semiconductor capacity, can they actually get it? And as you know, the U.S. has shut down and is not allowing more advanced semiconductor construction and equipment to be exported to China. And that includes Taiwan, that includes Japan, that includes South Korea. So again, these are some of those hindrances as Xi wants to try to drum up support, try to create some of this growth on the technological front. And the reason why that's so important, because the overall growth in the global semiconductor market is driven by automotive, data storage, and wireless industries. So when you look at where things are going, data storage, for anybody that's ever used Google and the amount of gigabytes that you get in your Gmail and your photos, that's a huge piece because people continue to need to store data. Then when you start looking at wireless industries, and if you just look at where we have the most people in the world, those are key areas, and China wants to capture that market, but it's going to be very difficult to do so without equipment, which continues to be a pressure point. But again, there's still a lot of trade. China needs us. The reason why we talk about this is because when you look at Russia, we were talking before, Russia essentially just said that they weren't going to take the terms that Russia offered. Why? Because who else is Russia going to sell it to? They have China, they have India. That's about it. So China and India can set terms, and Russia has to take them because they have to maintain a certain amount of throughput. So that leads us to where we are in China. So as we've been talking about the lending facilities, when you look at what is happening in the PBoC, 1 year medium term, the market expected 2.75%. They came in just right in at 2.85%, same as last month, no cut. Lending facility, again, new home prices, negative. Reserve requirement was cut, so that did release some cash, but again, still small. And they're doing things in small little pockets. So now when you start looking at some of the growth, industrial production was at 5%. The expectation was to be at 4%. So industrial production had some ramp, but this only captures March. So when you look at Q1, the lockdowns didn't start until March 26th. Some other areas, started earlier, but the big areas didn't start till the 26th. So that's when most of Q1 was taken care of. And all of that pressure is now really captured in April. Retail sales were expected to be down 3%. Instead, they were down 3.5%. So when you look at exports, when you look at flows, especially for March, you saw a big drop in exports, a big drop in imports. You saw retail sales slow, but yet GDP, as we know, was expected to be at 4.2%. It miraculously came in at 4.8%. And the question is, well, how did they do it? So fixed assets was expected to be at 8.4%, came in at 9.3%. Industrial production was expected to be at 6.2%. This is year on year, rather. Came in at 6.5%. Retail sales year over year, year to date, was expected to be at 2.8%, came in at 3.3%. Property investment was expected at 1.2%, came in at 0.7%. So retail sales have never actually beat. So the fact that it beat year to date, again, it comes down to people forgetting what the numbers are. But there's a lot of this uncertainty within it. And you're starting to see even locals starting to question, how is this data possible? Jobless rate was expected at 5.5%, came in at 5.8%. That's a big concern when you're starting to look at unemployment, leading back again to retail sales, because as retail sales slow, industrial production will slow because, again, how much can you export given you're getting some of these different shifts? PBoC, again, didn't do anything to help, as we've been saying. The prime rate was expected to be at 3.65%, came in at just the same as last month, 3.7%. 5-year prime rate was expected to be at 4.55%, came in at 4.6%, same as last month. The PBoC is weakening the yuan. They are taking it down. They are creating some of that because they'd rather discount the currency versus trying to some of the rates. Now, the Chinese government must ensure prices of materials for agriculture production remain stable. Remember, as we talked about last week, China is very concerned about food. They're very concerned about where things are going. Ensuring agriculture production and supplies are especially important given increasing uncertainties in the international market, COVID prevention policies and measures to ensure spring planting. They're constantly focused on trying to maintain these production levels. But now let's look at Chinese GDP and monthly activity. As you can see, retail sales have been at a downward trend and actually firmly negative going to this point. You see fixed investments have peaked and have fallen, and then industrial production has been fairly flat. So in March, industrial production growth slowed sharply to 5% year on year, down from 7.5% in the January-February period. In line with Trivium projections, the consensus for growth was at 4%. Fixed income investment growth slowed to 9.3% year on year in the first quarter, down from 12.2% in the first 2 months of the year. And that was expected to come in at 11.5%. So everything, again, is on a downward trajectory coming under pressure. So a lot of people were expecting increases in retail sales. Instead, we got a negative move. The pandemic stress on the economy also registered in the job market, and things got much worse. So then the economy apparently expanded at 4.8% in real terms last quarter. The print came in considerably better than expected, but nobody is buying the idea that the economy improved by such a large margin in Q1. There are two problems with the strong GDP numbers. First, it just doesn't stack up to reality. Industrial value-added output supposedly rose 6.5% in the first 3 months of the year, but electricity consumption in the sector was up only 3.1%. Fixed asset investment in the first 3 months of the year saw a 9.3% year-over-year increase, but production of steel and cement fell 10.5% and 12.1% respectively. The second problem is the vast chasm between the economic situation in Q1 now and the Chinese battle against COVID. Retail sales dropped 3.5% year on year in March, first fall since July 2020. Unemployment rose. Given the March data doesn't fully reflect how bad things are at the moment, expect things to show up in the April numbers. So again, there's a lot of this, well, how is this possible? And this is why we keep questioning some of this data. So getting more specific, industrial production expanded 0.39% month on month in March on a seasonally adjusted basis, slower than February's pace of 5.51%, but quicker than 0.34% growth in January. So again, you're still getting some of this slowdown, which is why we see PMI kind of flatlining. Obviously, we'll get another big move down in April. But then as things start to reopen, we will get back, but really not back to what? And that's when we look at slight expansion, maybe slight decline, but really hugging that 50 line. So then when you start looking at fixed asset investments, this is infrastructure, manufacturing. So when you look at real estate, firmly negative. When you look at manufacturing, coming down, while infrastructure investment has held flat. If you remember last week, we talked about special purpose bonds, specifically targeting the infrastructure side. So on a month-on-month basis, fixed asset investment growth eased to 0.6 in March from 0.7 in Feb. Infrastructure investment, which benefited from front-loaded fiscal stimulus, as we talked about, continued to be a major contributor. The pace of increase picked up to 8.5%, but that's something that as we progress, that's going to be harder and harder to come by, because one of the stipulations was you need to find good projects. Well, how many good projects could be left when you look at how elevated it's been since 2014? Manufacturing investment growth moderated to 15.6% year on year. Property investment expanded 0.7% year on year, down from 3.7%. So again, now looking at retail sales, again, that movement down. Service production on a month-on-month basis, retail sales fell 1.9% in March after expanding 0.2% in Feb and 0.6% in January. Weakest reading since July 2021. With a few exceptions, retail sales displayed broad weakness. Again, all of these things just continue to drum up why we struggle with it where things are. Going the other way, demand for basic foodstuffs remains strong. Obviously, people are locked down, which is why there's such a concern around food and making sure that there is food availability. Then when you look at the growth side, China consumption drops in Q1 as lockdowns hit. China funds raised by Chinese real estate developers was down 19.6% year on year at the end of March. China Jan to March property sales by floor area was down 13.8% year on year. New construction starts down 17.5% year on year. If you look at that industrial output, that's where we see some of the pressure, some of those, and then obviously jobless rates hitting the high since May 2020 of 5.8% continues to be the struggle. All the while, China credit impulses rebounded, but again, they fell, rebounded. They're still negative on a 12-month net change basis, slightly better on a 1-month basis, but this is something that we continue to see a sideways move. And the PBoC is trying to manage this, which is one of the things that we were talking about last week and why we think there's going to be pressure on how much easing they can do. And putting into perspective the unemployment rate, China retail sales, where they are versus 2021, continuing to be under pressure as unemployment accelerates, keeping more pressure on retail sales. Then the Lee index, better measure of industrial activity, and you can see that it is much closer to where China that GDP level is. We see some of that industrial activity flatlining. That's going to come under more pressure as we don't see them turning around and being able to speed up some of those movements. Now, the aggregate credit growth leads economic activity by 10 months. So as you get some of this flatlining, you'll see some of this move down, and it's going to go below 50. Again, this is where we're going to get that slowdown. And then that flatlining, credit impulses coming up a little bit. But again, they're trying to hold things at a stable level because they know they have to try to pull out some of this excess liquidity. And that's going to keep some of where this growth can really be. And they're going to use COVID as that key excuse. Logistics throughput weakens significantly as COVID controls continue to tighten. When you look at 2022, now if you look at that gap, and again, even before COVID, even before the lockdowns, you saw 2022 coming in very different than 2021, already showing some of these pressure points, and it's only gotten worse. Now, the ability to close that gap is going to be a big struggle given where demand is and how the global market continues to struggle, which is then when you look at the number of trucks in use in Shanghai at less than 20% of normal levels. Now, this is something that they're trying to correct. They're trying to alleviate. They're trying to open back up because they continue to see a lot of these pressure points and a lot of these underlying issues with shortages and a lot of pressure points, which they're trying to correct and they're trying to fix in general. The recent decline in property sales is unusual and continues to be the national trend. And again, it's not surprising just given the pressure that continues in the system. Property sales are now about half of the 2019 level, and that's not going to change just given where the consumer sits. Just look at retail sales, look at unemployment, look at cost. We keep talking about how expensive these different things are at this point in time, and we don't see that changing. And that's why there is no sign of recovery in the land market, which is what we've been talking about. But this is also a key way that provinces make money. And when you look at taxes being cut, when you look at VAT taxes and other forms of government income coming under pressure, this is going to lead to additional problems. China new home prices, latest is 0.66% year on year, continuing to fall, which is, again, a big problem because a huge amount of wealth and net worth is derived from home prices and real estate in China. The required deposit reserve ratio came in 11.25%. Again, opening up a little bit of additional liquidity, but again, that's where they're continuing to remain tight on some of the other key areas. Online sales growth slows in a maturing market further as we continue to talk about consumer internet giant revenue growth also slowing. This is, again, retail sales. This is local buying. Internet. It's just there's not a lot. As they continue to try to drum up support, that dual circulation strategy, common prosperity, they're going to continue to struggle. Japan net equity investment abroad has fallen through a floor, and this is all also coming at a time that the rates continue to go up, and the Japanese, the BOJ, the Bank of Japan, is now buying as many bonds. There's an unlimited amount of buying because, yay, quantitative easing. And so there is a huge drop in investment abroad. We've seen the Japanese be huge sellers of treasuries, and instead they're now selling, and you're seeing just more pressure and more stimulus. On that front, when you look at housing as a share of the different pieces, urban floor space and construction in China continues to come under pressure. Baseline growth, best case growth, housing investment share of GDP, again, all of it moving in the wrong direction. While South Korean monetary policy, they raised rates again to 0.25% by 25 basis points to 1.5% as inflation continues to run well above their target. And that is something that they continue to export, and the U.S. is buying. South Korean inflation, as you can see, CPI change year on year continues to move up. Month over month annualized change, as you can see, at north of 8%. Core is sitting at about 4%, which is why we're going to continue to see those rate hikes, and will put pressure on underlying growth. Japan, when you look at industrial production, came in at 2%. Condominium sales came in negative. And then when you look at exports were expected to be at 17.1%, came in at 14.7%, a little bit slower, but still a record when you look at the actual dollar value. Imports were expected to be up 28.9%, came in up 31.2%, which is, again, a positive leading indicator for where exports are going to go. But then when you look at total foreign visitors in Japan, when you look at the number of people, travel still remains just a flat line around the world. And this is just showing, again, why we don't think we're going to see a normalized, flight plan for several years at a minimum. Food contribution to headline CPI inflation in India. You can see just CPI inflation is rising. This is why, again, we're going to allow India to continue to buy euros, continue to trade with Russia, because they need to address this. They need to try to protect this. We continue to see this moving much closer to about 5% over the near term. And it's, again, something that they're going to have to try to pass off to the U.S. in terms of some sort of protection. All the while, the Japanese 10-year government bond yield is going to be flat at that 0.25% because that's where they fixed it, and they will be buying as much as possible. All the while, India wholesale price index was expected at 13.3%, actual coming in at 14.5%. So again, you're seeing quantitative easing from Japan. You're going to have more tightening from India, and that's going to create some of this weird underpinnings of what is happening in Asia and where is growth going to be. We continue to remain concerned about India. We think Vietnam is in a better position, especially when you look at recent trade data. But prices are going up. Inflation is very much going to be a problem across the Asian continent, especially as the food issues that we talked about in segment 1 and that we've been talking about since realistically 2020 continue to play out. So if you have any questions, please find us in the comments section, or you can find me on Twitter. Always happy to go back and forth with any comments or questions that you may have. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primer Vision Network.